Again, I'm Daniel Krug from Daniel Krug and Associates, and we're going to talk about where we've been. And we're going to start with the City National Rockdale speedometers. Now, most of you have already seen these before. City National is one of our high net worth institutional money managers, and they do a phenomenal job not only in managing the portfolios, but they do an awesome job in research. And we get a lot of research from them, them and many other money managers and institutional players. However, the one point of contact with some of their research is their speedometers. And this speedometer really is looking at the beginning of last year, so January 2021. And if you think about it, we were coming out of that recession that we kind of put ourselves in, and we started out after March with a whole lot of red showing up on these speed dials. And as you can see, by the time January came around, things were looking a whole lot better, and there was a lot of hope walking towards relative to the economy. Now, one thing that started to be a question mark was the inflation dial. There was talk about how because of the labor shortages and then the subsequent raises everybody was getting, so labor prices were going up. We all know that when labor goes up, it kind of affects everything from a cost standpoint. So inflation was one of the big talking points at the end of last year, or the beginning of last year. So what ended up happening from an inflation standpoint? Well, the reality is we ended up with about a 7% inflation last year. Now, when you think about it, we've been running right around 2%. That's what the Fed wants, right? They want about a 2% long-term inflation rate. So this is a bit higher, no doubt about it. And if you think about it, it's as high as it was all the way back, going back to 1980-85 when the interest rates were coming down. Who was around when the interest rates were like 17-18%? I know Rocky always talks about his first mortgage was at like 18%. So it was really out of control, and that was the talk. You know, is inflation going to get like it was back in the 70s and 80s? And we don't believe it's going to, and there's multiple reasons for that. Let's push forward to the end of December of 2021. And did the inflation actually needle start moving backwards? Yeah, it started getting closer to the neutral side. Now, one might say, well, if inflation was at 7%, why wouldn't the inflation dial be a little bit higher? Well, because there was a bit of a dichotomy with inflation. It was kind of like the first time anybody heard about the stock market's K recovery was like in 2020, right? Part of the market didn't go up, the other part was screaming up. Well, we kind of have that dichotomy with inflation at this point as well. There are certain things that are really overinflated. There are others that are just a little bit high, and we'll talk a little bit more about that. When it comes to the Fed and the stock market and inflation, because you know the stock market is the best hedge against inflation, so how does the Fed rate increases that they're projecting, which they're looking at 3 to 4 in 2022, how does that affect the stock markets historically, and how is it going to affect overall inflation? Well, if you look at the stock market specifically, and you think about the historical average relative to the first Fed rate hike, and can anybody tell me what the rates are right now, the Fed rate? It's like 0.13. It's really low. I mean, it's like really, really low. So for it to go up, you know, even 1% over the year still puts us where? Really, really low from a rate standpoint. And the market knows this, and the market is forward thinking. They're thinking, okay, what do we need to do to adjust to a 1% overall rate hike? So when you're looking at the history, what this chart shows is you've got the average rate of return based on 3, 6, and 12-month periods. And then you've got the median. And you might say, well, why is the median so much different than the average? Well, because the median's taking into account fluctuations and volatility in the market, where that number is going to be a little bit different. But you go out 6 months and you can see an average 7% rate of return historically, which happens over 85% of the time. The markets take care of itself. We're not really concerned about the rate hikes this year. Is it going to create some volatility? Yes, it is. If you go all the way out to 12 months, you can see a pretty big difference, 10% and 6% between the average and the median. What does that tell you? It tells you that there's a lot of volatility going on in order to get to that 10% number. And again, that's not a bad thing. Volatility is not bad. Volatility, I would put it this way, a market without volatility is a market without returns, generally speaking. The volatility is what creates the opportunities that get you the enhanced returns down the road. And right now, we're in the process of what I would call a great opportunity from a tax mitigation standpoint. So, what about inflation? Well, let's talk a little bit about inflation. When you think about inflation, it's really the tale of two cities going on from an inflation standpoint. And I don't know if you've heard about this, but there's what we call sticky inflation, and there's flexible inflation. And the reality is sticky inflation is the inflation that doesn't move very fast. And it's the goods that don't vacillate anywhere near as much on a short-term period as it may long-term. I mean, it may gradually go up long-term. You can kind of see how that ebbs and flows over time. The flexible inflation is where the problem is right now. The flexible inflation is at 17.9%, which is outrageous, right? Well, what's causing? What are the areas that are causing that high inflation right there? Automobiles. If you buy a used automobile, they're about 30% higher than they were a year ago. You buy a new vehicle, it's over 12.5% higher than it was a year ago. You do any kind of construction, oh my goodness, you're 30, 40% above the previous year. So there's segments that are really kind of out of control, and that's what the flexible interest or the flexible inflation is looking at. But the biggest thing I want you to walk away with on this is that the average ended up around 7%. We hear about all this up here in the high numbers of inflation. And certainly we're feeling it at the pumps right now, right? The topic of conversation yesterday was how much it costs to fill up the tank with a full tank of gas, and it was just crazy. And it happens so fast, too. But we'll talk a little bit about that as well. So let's go to the market now. Let's talk about the year-end returns, because even with the inflation talk towards the end of the year, the last quarter of last year, most of the talk was either inflation or it was all the mass changes they were going to have in the tax codes. And they were big. What they were talking about were just huge changes, and you were literally seeing companies go and sell off a lot of capital gain positions so they wouldn't get whacked by where they were talking about going with capital gains. And the funny thing is, well, actually it's not funny, it kind of makes me schizophrenic, is that 2 weeks after the end of the year, what happened? Well, virtually nothing when it comes to the taxes. They didn't change anything. So that's creating some volatility in the market towards the end of the year. But that being said, these are how the numbers played out. All in all, I would say that was a pretty good year unless you were really into bonds. if you were really into bonds, which the average investor who is conservative probably didn't fare too well last year. Now, when I say average investor, I'm certainly not talking about you guys, right? Because the average investor who's just in a bond portfolio is kind of stuck there. There's no movement. You just have to ride through it. And there are going to be years when you're down. There's going to be years when you're up. But at the end of the day, you know, we've talked about this before. We're in a secular bear market for bonds. So a secular bear market for bonds can last 30 years. So if you're a conservative investor just sitting in bonds, I'm here to tell you, you're not going to get the rate of return you were getting in the past. You will still have bulls and bears within that secular market. But this is just an example of what's going on in that market. We're in the midst of a bear rolling in that secular market. And there's a lot of other things playing against that as well. Emerging markets, they certainly have taken off like a lot of the institutional money managers felt there is opportunity for it to push forward with. In other words, they thought that was going to be very positive by the end of last year, but it still hasn't been. How did everybody like their portfolios at the end of the year? I mean, were they just like awesome? So here we are, 2.5 months into the new year, and well, what are we looking like with the speedometers? Well, guess what happened with inflation? It's actually starting to rear its head right now. But again, if you have sticky inflation's relatively low at 3.5, the other inflation is driven primarily via supply and demand. There's a lot of demand, but not a whole lot of supply. And that's one of the things that's raising the rates up. It is incredible, and especially in the building community right now, they're virtually calling their shots on what it's going to cost to build something. And it is probably not the best time to build anything right now. If you could wait a couple years, I would recommend doing that. Some of the other changes that were made is when you're looking at the geopolitical risk, it went red again. Now, it's not too often that it's yellow, but the fact is it's now red. Now, why is that? Well, you've got what's going on over in Europe now with Russia invading Ukraine. Now, that in itself, this geopolitical risk is causing a problem over here. Why? Well, because we shut down our Keystone pipeline, which we were fully energy independent. Well, that's a good point. I didn't do it. You didn't do it. But as a country, we ended up shutting down the Keystone pipeline. So now what are we doing? We're literally buying our oil from the enemy. Doesn't make a whole lot of sense, but that's where I might tell you to write your congressman and say, you know what, let's get that Keystone opened back up, even if it's just until this crisis is over. You know, that way you give them an out a little bit right there. We do have some issues coming up on the horizon that are going to have to be addressed. But at the end of the day, when it comes to the inflation part, which is really one of the bigger issues, not the biggest issue, but one of the bigger issues, we believe by the end of 2022, maybe mid-2023, things will have stabilized from a inflation standpoint. And why do we believe that? Because they're opening up all of the arenas out there, and we believe the supply will get back online again. And that will lower the prices back down. So we just have to kind of push through the next year, and I believe that the inflation thing is going to take care of itself. Now, will it be down to a 2% level at that point? Probably not yet. You know, it might be at 3.5, which is what they're projecting for 2022. But that would surely be a whole lot better than what we're seeing right now, which means all that flexible will be the ones that really start coming down to a normal level again, or somewhat normal. So at this point, you look at all the rest of the indicators, and we're still looking very positive, and we're not looking at much movement either. So you look at international economic outlook, that moved a little bit, but not much, even with everything that's going on. Because from an economic standpoint, we're not seeing the problem out there that the news might be portraying. And you all know how I feel about the news. When you're looking at the market, volatility, which we're feeling right now, and we've been feeling for the last two and a half months, it's just a painful return to normal. Volatility in the market is a very normal situation, but this is 2021. And if you look at 2021, it was almost a straight ride up. The only time it got a little bit gyrated was when they really started talking about how bad taxes were going to be. Now, that was nice, and I'm sure everybody would like to do this again. But we are going back to normal. And in this normal market, we're coming out of earnings season, right? Did anybody really hear about earnings season in 2021? No. Why? Because the profits were all there, which is one of the reasons why we didn't have the gyration in the market. But now we have problems in some of the companies as far as not hitting their targets. I mean, think about Facebook. Facebook lost over 2 million subscribers. And I think rightfully so. Maybe they should lose another 5 million. But the reality is Facebook tanked. And they're a large percentage, when you think about 500 companies, they have a large percentage of the S&P 500 and the NASDAQ for that matter. So now that we're back to some kind of normalcy, we're in a state whereby you're going to have good news that you hear from earnings call, and you're going to have bad news that you hear from an earnings call. And all this is going to make the market fluctuate a bit. When you look at the way this has turned out for the first 2.5 months, you can see that U.S. large cap and U.S. equity income really has fared the best over the last year. So the last year returns, you're looking at really this color here. On the far side of the screen there, you can see that year to date, for the last year, we're still ahead quite handily in the U.S. market. Now, where are we having a little bit of a problem? Mid and small cap is having a little bit of an issue. When you think about your portfolios with the institutional money managers we have right now, we're really heavy weighted on U.S. equities, large cap mostly, which is why when I'm doing reviews with clients, we're still seeing that 1 year return, going back 1 year, we're still seeing it in double digits for most of our clients. Because again, we're weighted more in the U.S. If we were over in the other areas, we'd probably be singing a little bit different tune. But again, we don't have a whole lot international at this point. So that's a very good thing. Now, if we have a client, because I've had clients say, well, are we going to make any changes to the portfolio? Well, there's two things you want to think about. The first thing is most of you have tactical money managers which are already making adjustments to the portfolio. So they do that internally as they see, one company come out of favor and another one going on to favor. So they're making those adjustments already. The other thing is if you have a structured portfolio, which is one that's really kind of investing through all the different asset classes, at, a certain percentage for each one, and the money manager just rebalances on a quarterly basis. We have structured portfolios, but we're not overweighted in most cases in those portfolios. So still, even if you have a mixture of tactical and structured portfolios, you're not going to have a whole lot in the other arena that's not really performing at this point. So, but if you do, in other words, if you do have a little overweight on the structured portfolios, we are making adjustments out of those and shifting more to the tactical at this point. So there are adjustments being made literally on multiple levels to your portfolios to make sure that we're going to get the best opportunities to move forward in the future. Make sense? Okay. Now, each time we do these meetings, we have to talk about debt, right? It's my favorite subject. Now, you've heard me say that I believe that the biggest wealth robber in the future is going to be taxes. That is why our firm is pushing so hard to get everybody as tax-free as possible moving forward. Because just looking at what they were trying to do for the change in taxes for 2022 kind of woke a lot of people up thinking, you know what, this is kind of imminent. Now, why do I believe that they didn't do the taxes, the major tax increases? Well, there's two schools of thought. One is that, well, because inflation's so high, they didn't want to kind of mess things up a little bit. The other one is that the current administration is a little bit concerned about midterms, and they didn't want to put the nail in the coffin by raising taxes at the same time. Now, could it be a little bit of both? Yeah, probably is. Probably is. But at the end of the day, taxes are going to have to go up, and you're going to see why as we go through a few slides here. First of all, this slide kind of gives you an understanding. The mountain chart is the debt held by the public based on a percent of GDP. So you can see it was very high back after World War II, right? We're ready to eclipse that based on the spending that they want to do. And I say they, I mean our politicians. I would say they were representatives of the people, but they're not. They're politicians. And I'll probably get the FBI at my door on that one too. But putting that aside, at the end of the day, and by the way, it's not just Republicans, it's not just Democrats. I think it's a mixture of them that we've got a problem with. So I just want to be fair and balanced in my reporting here. So when you look at this, you can see in Trump's era, the debt actually stayed pretty low until when? Until we had the pandemic. And then it started rising rapidly as we started giving money away to individuals. And they're expecting it to continue up unless there's some kind of stop. In other words, we just don't do as much spending, or we increase taxes dramatically. So moving forward, when you're looking at this, back from Obama, at the top of Obama, we were only at about 76% of GDP. It went up a little bit with Trump before the whole thing with the pandemic started. But now we're sitting at 102% of GDP. That's not a good place to be. Here's where our debt is. We're at over $30 trillion in debt right now. That means that every individual, every single person, you know, that little baby that was just born, all the way to the guy that's ready to check out, almost $91,000 has to be paid by everybody to get the debt down. And that's going to mean taxes, right? You go back to 2020, 2 years ago, and we were at 27.8. So that's a pretty big increase in that short period of time. It's interesting, though, if you went back to 2018, we were at, I think, around 25 at that point, 25, 26 trillion. And the service on the debt, in other words, the interest, was about $500 billion a year, which really we can handle that kind of debt load. We can do it. It's not the best thing in the world, but we can financially handle it. The interesting thing is at 30 plus trillion, we're actually paying a little bit less in interest right now. Do you know why? because the interest rates today are lower than they were back in 2018. Now, you guys can do the math, right? If we have now $30 trillion in debt, and the interest rates creep up just 3%, we cannot handle that debt load. We can't. It's going to be over $1 trillion a year. A lot of money. So again, I'm going to ask you to call, email, write your representatives and tell them we need to get this under control. This is the sobering slide right here. So think of your household. Can you imagine if your total revenues were 3.42, but you were spending 6.55 trillion a year? How long would it take before the bank came and kicked you out? Yeah. But this is the problem right here. And this is one of the reasons why they were talking so heavily about raising taxes. Now, the problem is they were also talking about raising spending. You can't do that. Now, the only comforting silver lining, if you will, is the whole world looks like this. So who knows? Maybe there's going to be some kind of major reset or something that brings everything, I don't know. I really don't know how they're going to fix this thing. But what I do know is the taxes going up are imminent. They're coming. And the great thing is when I look at the industry as a whole, the financial industry as a whole, and where most advisory firms are with their clients' tax-free money, it's somewhere between 2 and 5%. 5% would really be a high side. 5% of their total assets that they're managing for clients. Ours is somewhere north of 25% right now. Huge difference. And the great thing is, when you're talking about what's going on with the market, this is where the opportunities come in, where if we do Roth conversions right now while the market is down, because we firmly believe that the market will be up somewhere between 8 and 10% by the end of the year. So think about this. If you converted at 8%, your IRA to a Roth, you pay the taxes, get it out of the way. The market goes up 8%. That's a 16% swing tax-free. Now is a great time to do Roth conversions. So if anybody needs to do it, or if they haven't done it already, because I'll tell you, I've had a lot of clients already call up and ask, is this a good time to do it? And we just started implementing right now, because the answer is yes. The other thing is if you have money on the sideline, oh my goodness, this is a good time to get it into the kitty. Because let's say the market even goes down another 5% and we put it in today, all right? Because some people would say, oh shoot, I just lost 5%. No. Just give it a little time to season, because at the end of the year, you're still going to be up and you're still going to win. So don't try to time the bottom, because no one can time the bottom. Just get it in while it's down, and it will capitulate, come back up, and we'll have a pretty good year by the end of the year, unless, I have to put this caveat in there, unless there's some kind of black swan event that kind of changes the course of everything. Everybody knows what a black swan is, right? You don't know when it's going to come, you don't know what it is, and you don't know how it's going to impact things. That's a black swan. So that one's kind of always out there, I suppose. Now, geopolitical crisis. Now we've got Ukraine. I have had many clients come into our office and it's like, oh my goodness, what's going on with Ukraine, Russia, how's that going to affect the market? And at the end of the day, you really got to think of it from a GDP standpoint, the gross domestic product. The company or the country that's going to get hit the worst relative to this crisis, you can kind of guess. It's going to be Ukraine. It will be one of them that gets hit hard. Because why? They're being invaded. But the fact is, with Ukraine, it's not going to derail the global growth that is going on right now. It's not that big, and I'll get into some examples. But after Russia, Europe is expected to be the next one that gets hit the hardest. But again, we're not over in Europe that much with the investments. So that's why the portfolios are not going to be affected long term by that. You can see where the U.S. is. It's right around 2%. It's a blip for us. And that's, again, why we're in the U.S. So the impact for us is going to be relatively minimal. You look at all the different countries lined up here, Hungary all the way to Australia. Obviously, the smaller the bar is, the less effect to that country. So Russia's got the 11th largest economy. But really, it's less than 2% of the total global GDP. So really not that much. The U.S. trade flows with Russia and Ukraine, about 1/4%. So again, not really going to affect the U.S. Europe is the one that's going to be exposed the most because they're tied to it the most. But again, we're very limited relative to our investment exposure to Europe. So we're not believing this is going to be anything that we have to worry about long term. Think about all these different shock waves, geopolitical events that happened. Oh, wait a minute, we forgot one on there, didn't we? Let's throw the pandemic in there. It's interesting because when people come in, many will say, well, this is different. Well, it's different, but the market's going to react the same, historically. What do I mean by that? Well, just look at this. Equity markets have historically just pushed through these geopolitical events. So if you've got a long-term horizon when it comes to investing, and that's what our clients do, they have long-term horizon. They have got a long-term view. Many of you are legacy-minded, so the money's going on to heirs. So that is a very long-term view. And the long-term view, it's interesting. Mark Mattson said it like this. I can't tell you when the next 10% drop in the market's going to be, but I can tell you when the next 200% return's going to be, and that's in the future. And there's a lot of truth there. So even with the financial crisis, the money managers really have done an awesome job in making adjustments. That was probably the worst near-term thing people have experienced because the stock market was down, what, like 53%. Pretty nasty. But we got through it. Well, the most conservative clients were back to even within a year. The most aggressive clients were back to even within 2. Now, comparatively speaking to the S&P 500, the S&P 500 took to 2015 before it got back to even. So our clients and your investments were way ahead of the curve. And that's the money managers again. So, I would like to tie it up by saying this. It was 2021, it was kind of like the tale of two cities on many fronts. Many people just didn't feel like things were right, but on the flip side, when it comes to the market, well, you couldn't have gotten more right in the market, right? It was just skyrocketing. Inflation, you got the upside and you got the downside, but it is going to normalize within about a year and a half. And as far as Ukraine and Russia are concerned, not likely that it's going to be anything more than a blip from an investment standpoint on our radar. Certainly there's a toll of human tragedy going on. But from an investment standpoint, because we are so overweighted on the U.S., it's not really going to affect us as clients. Okay? All right, so any questions?
The Roth conversions, is there an average amount people are converting, or is there a regulated amount that
Okay, the Roth conversions, number one, there's no limit on how much you can do, so it's really how much can I stomach. Secondly, most of the clients have a long-term plan already structured. If you don't, we want to take a look at it more long-term. Now, what is long-term? Well, you tell me when they're actually going to flip the switch on the taxes, and that'll give you that number, that time frame. But it really comes down to how much do we have to convert. We don't need to convert 100% for most clients. Most clients can keep 100 or 150,000 in IRA money, and we can whittle that away through deductions for the most part.
What about RMDs? Can they go into Roth conversion?
No, RMDs cannot, required minimum distributions cannot go into, but let's face it, the more we put into Roth IRAs, the less required minimum distribution you take. And if you're someone who really doesn't need to take the money out and Uncle Sam's forcing you, then a Roth conversion makes sense there too, because now you have control of when to take the money out. And I'm big on control. So if you're thinking about a Roth conversion, call the wealth manager. They'll work out a plan with you within reason relative to your tax brackets. But I will tell you this, I've got many clients that are doubling down this year because this may be the last year to convert. We don't know. Because that Roth conversions was actually on the chopping block this time, big time. Because they don't want to defer these taxes, or they don't want people to be in a tax-free position moving forward with the debt we've got going right now. Now, is our one firm going to change their mind? Probably not. But let's get ourselves in the best position possible. I know it's painful. I've written a lot of big checks converting all my money over. But I know the numbers. The numbers long term are a big win. Big, big win for everybody. So you don't want to talk to the wealth manager at that point to kind of go over what the plan is for you. Okay, that being said, I'm going to go ahead and bring Rocky up.
Where we may be going, does anybody know? But it depends how far out you want to look, right? So let's talk a little bit about some of the signs that we see, some of the history we can learn from. First off, I'm going to start with the Institute of Supply Management. It's probably one of the largest organizations that studies everything from economists to actual businesses. And they just are a big research center. And what they track is probably some of the most followed data, for other business owners to tell where the economy is going in the future. This first chart basically is talking about the service industry and the manufacturing industry. Those are the two different colors. But if you're above this line, they're basically saying that future orders in those industries are positive. If you're below this line, it's negative. So this is future orders. Right now, we're sitting on future orders still above average. That talks about expansion, right? People are buying, the companies are buying in anticipation of future growth. This one talks about what the prices they're paying for their materials relates to the consumer price index, what we're paying to buy their goods and services. And what you can see here is that the dark is the consumer price index. It's at an almost all-time high, right? We're aware of that. Inflation is going on, supply chain disruptions, right? You can't get cars like you used to get cars, stuff like that. So it impacts the pricing. But look what we've seen recently in the trend of what the manufacturers are paying for their goods and services. First time in a while we're seeing a downtrend. That's actually a good sign, because that means that generally consumer prices are going to flatten. What's not in this equation totally is the Ukraine-Russia crisis. But we were having supply chain disruptions, right, that they were talking about coming out of COVID. That seems to be subsiding. So that's a good thing for the economy. How do people feel about the economy in the future? This also is kind of like shows you an optimistic or pessimistic view. And what we've known from history in the past, we're actually pretty pessimistic with everything that's going on in the world right now, right? And the stock market's reflected that. We're in a major correction in the stock market. But Generally, when we're pessimistic now, 6 to 12 months from now, things start to turn around, and we actually, historically, look at these 3-month returns and past negative consumer feelings about, is the economy doing well or not? So contrast this. We just talked about businesses. They're feeling better. The consumer is not. Generally, the consumer follows, right? So that's an actual positive for the market moving forward. Credit fundamentals, borrowing, the corporate bonds and things like that. What's going on in that market? This line represents kind of an average of where we see the strength of credit within a company, okay, and all the companies across the United States. Basically, it's ticked up. Is that a concern? Well, if you see here on the second bullet point, they're basically saying that the increased costs are due to higher treasury yields, okay? So this is not a deterioration in corporate credit conditions. Why? Fundamentally, the balance sheets of companies are very strong, the strongest they've been probably since 2008 or 2007, right before the crisis, right? So companies have cash. Companies are doing well. They're keeping their costs in line relative to supply chain issues, inflation, things like that. So their credit worthiness is very strong. So as we expect interest rates to increase this year, as Dan talked about, we don't expect to see a huge credit issue. The credit markets, if you remember, what do they call the 2008 crash? A financial system crash, right? Not only a stock market crash, but the credit system crashed underneath it, right? So we had a double whammy. Things look totally different now than they did back in 2007 and 8. Earnings. Okay, basically what we're expecting in 2022 is a drop in earnings. Okay, we are expecting less return and less growth in the market. However, 8% projected for this year is still above the 5 to 7% average. Okay, and when we look at 2021, the 48% growth in earnings, where were we in 2020? COVID, everything went negative. So actually, last year was kind of a representative of 2-year catch-up. So if you divide that in half, it'd be more like 24 over the last 2 years, okay? And where is the biggest decrease taking place? In margins, okay? And why are margins being squeezed? Right there, higher input costs. It's costing more. Inflation is taking a hit. They've had to pay more for materials, and they've had to absorb a lot of the costs. Okay, the consumer was winning out a little bit, okay, but that catches up. From an earnings standpoint, we expect companies to earn money. That's going to relate to staying invested in the stock market, okay, because it's still, we're expecting above earnings, even moving forward into 23 and 24. Okay, this is a chart basically talking about the two different types of stocks we have in equities. We have growth stocks and we have dividend stocks, right? And so this chart tracks, the dark blue is the S&P in total, and the light blue is select dividend companies within the S&P. Those companies that pay a decent dividend on their stock. If you notice, they tend to trend kind of together. But what happened coming out of COVID? They separated. Growth stocks extremely outperformed dividend stocks. Who were these companies? Amazon, Google, Netflix, right? The companies that don't pay a lot of dividends, like a Johnson & Johnson or Procter & Gamble, right? But what tends to happen over time whenever there's splits? They seem to come together. So right now we're saying dividend stocks are undervalued. Growth stocks are overvalued. They're going to meet in the middle. Okay, that's part of the correction that's going on, is it's mostly taking the hit in the growth companies that escalated so much after COVID, right? You could buy Amazon, you couldn't walk into a store, right? So those companies were really profiting through here, and it was reflected in their stock values. So we have to make adjustments in the portfolio, okay? And we're doing that. And it says on top there, you know, the dividend stocks have outperformed the overall S&P by about 10%. Now it's down, but those are the ones that are going to buoy the S&P for the future, and we believe that's going to continue. So the portfolio managers are making these adjustments. You ride this horse, overweight to growth. Now you start to overweight to dividend, value stocks, okay? So just to recap, make it kind of the things I want you to take away from here today. Uncertainty continues to fuel market volatility. This isn't going away. It was COVID, now it's Ukraine, Russia. But Dan showed that even after different crises, you know, should you pull out of the market and stay out? No. You know, if you've got a long-term goal, you're going to reach those goals by staying invested. Do we make adjustments along the way? Absolutely. And we're going to make those adjustments. Interest rate increases are coming. Inflation will remain elevated this year. Okay, again, the Ukraine-Russia situation has caused gasoline, things like that, to continue to go up while other supply chain issues were being brought into check. Europe, because Dan showed you how much more Europe was dependent on Russia versus the US, where do we want to invest? In the US. We've been talking about that for years now. Okay? We want to stay focused in the U.S. In fact, we're believing because of what's going on with Russia and Ukraine, a lot of money flows are going to flow into the U.S. market. The U.S. market's down. Who's going to invest in Germany right now? You don't want to be investing in their market. Their whole economy is dependent on Russian oil. Okay? They said they don't need any this winter, but okay. How much of that is the truth and just positioning, right? So we kind of want to be careful about being in Europe and in overseas markets. The good news, U.S. economy continues to expand. We see still 2 to 3 more years of expansion in the U.S. Business owners are remaining optimistic. If they're optimistic, they will continue to invest capital for the future. So that's a good sign. And then this is referring to the other part, the Fed, even though they're going to raise interest rates, they've already said we're going to slow it down. Everybody was expecting about a 0.5% increase next week. The Fed's going to raise interest rates next week, okay? But now the expectation is 25. They're tapering, and their interest rate increases are being brought down, which is also going to help the market long term because borrowing costs are going to stay low. Okay? A couple other things. Credit defaults, historically low. Corporate earnings, above average. Okay? So you watch the news and it says, get out of Dodge. You watch the economics and it says there's room to grow. Okay? It's just pay attention to where you're overweighting and underweighting the portfolio. Okay? Any questions on this? See how quick I can be? So what I'm going to do is bring up Dan to recap and close us out. So Dan?
Okay. Well, I'm feeling much better about technology right now. It's actually working. Okay, we're just going to do a quick wrap up here. Your action items for 2022, so steps that you need to take moving forward. And when we're looking at this, they're not little tasks like where you have to write things down. They're event kind of driven. So for here, I want you to keep us in the loop on any kind of life changes that are going on for you. Because if there's a life change, there's more than likely something that we're going to need to do to help you through that change. So if something comes up, let us know so we can make whatever adjustments that you need. And then if you have investment concerns, talk to your wealth manager, because at the end of the day, they know your personal strategy. They know you. So if we have to make some adjustments, we'll certainly do that. Most of the time, it's really more of a coaching type call to make you more comfortable based on facts of what's happening out there. But let us know if you have any concerns there or any questions. And then, this one's a big deal here too, is making sure that your legal and financial documents are up to date. And the reason I say this is that the whole industry, the financial industry, has kind of moved in such a way from a legal standpoint that they are now, in many cases, looking at estate plans, and if the estate plan was done more than 3 years ago, they're frequently asking us to get a recertification of whatever that document is. So that's the bad news, because anytime you do a recertification, what does it mean? Yeah, it's going to take something for an attorney to make the adjustments on the document or do a certification of it. But you want to make sure they're up to date, because the worst thing that could ever happen is you thought your estate plan was going to do one thing, and because of whatever reason, it ends up doing the opposite of what you want. We don't want that to happen to you. So if we have documents that we feel need some kind of certification or an update, we want to make sure that's taken care of for you. Our steps for you folks is, number one, really keep you informed through regular communication. We want to make sure that, and we firmly believe that the more you're educated on what's going on, the more comfortable you are, the more success you're going to have with your investments and your overall circle of wealth. And then the other, when it comes to the investments, we're going to make whatever adjustments are needed based on your personal strategy. It's not the news strategy, it's not your neighbor down the street strategy, it's really your personal strategy. And the interesting thing in knowing everybody here, I can tell you that everybody has a different strategy that is playing out based on your personal situation. So we're always going to look at the investment part from a personal strategy standpoint. And then the last one, we're going to stay on top of the market. If we do have to make some adjustments, and we will, we have in the past, but if we need to make some adjustments, we're certainly going to do that. And we're always, again, keeping your investments, your plan in mind. And this is where, again, if we were a typical firm out there and Rocky and I had 1,000 clients, it's going to be very tough to say something like this, right? Because how could you know 1,000 people? I mean, intimately enough to know what they need. The reality is you're not. But because we have a limited number of clients that we work with, it makes understanding and knowing you a whole lot better. So we can almost anticipate your needs. So that's our job, is to make sure that we stay in touch with you. Lastly is the upcoming events, which the next event we have is a webinar. So it's not a live event. Well, it is live, but it's on a webinar. It'll be Thursday, April 7th at 11 o'clock. Everybody will get an invitation to that coming out. If you miss that, just like if someone missed this meeting here today, we are going to have it recorded. It will show up on YouTube and on our website, so you can actually go back and either review it or watch it for the first time. So that brings us pretty much to the end. So here's our saying. Don't really worry, because I don't think there's anything to worry about so much. You take care of your family, and we'll take care of you, because we are ready for 2022 and beyond, just like Buzz Lightyear. To infinity and beyond. Okay. All right, so that's it.